Hello, and welcome to the Invest with Carl podcast. I'm Jamie Uppenberg, your host and a member of the Carl team. Today, we're meeting with Sam Sivarajan. Sam is a personal finance expert and has run teams of financial advisors at some of the largest financial firms in the world, advising some of the most wealthy people in the world. Yes, I did say some of the most wealthy people in the world. So he knows what he's talking about. He has a new book called Making Your Money Work: The Secrets to Financial Health. So he's here to chat about his book, and obviously we'll bring that back around to investing in quantitative hedge funds. Welcome, Sam. How are you?
Very good, Jamie. Pleasure to be here.
All right. So you've got a new book out, and obviously you've been financial advising for many years. Why don't you tell us what the book is all about? How did this come to be?
It's a great question. I think I have been in the financial services industry for about 25 years and working, as you said, with some of the wealthiest people in the world. What I did find is not wealth doesn't necessarily translate into understanding some of the concepts on how to build a long-term portfolio. And as we've gone through the last 10, 15 years, I've also noticed that this is a theme that I think most people, not just the very wealthy, can use help with as they're saving for their retirement, as they're saving for their children's education, as they're saving for, a second home or a first home. And what I thought was important is there's so much noise in the marketplace right now about get rich quick schemes, meme stocks, et cetera. And I thought it's important to kind of make sure that people have the right foundations on how to build long-term wealth. And I think the premise is that if you get the basics right, I think you're going to be in a good place for your future financial health. And that's really the impetus to write the book, to take the lessons that I've learned and been able to put into practice with some of the wealthy clients that you mentioned, and bring it home to the average person so that they can use those same lessons in their day-to-day lives.
So, part of what's interesting about that is it different managing wealth for the uber wealthy, or did you find that it's really the same techniques that when you bring it down to a smaller amount?
Yeah, I think one of the things I say in the book is that investing is simple, but it's not easy. And what I mean by that is that the concepts or the principles are not different, whether you are investing $1,000 or $100 million. I think the tools that you might be able to use are slightly different, but the objectives and the principles and the framework that you build is exactly the same. And that's what I was trying to get at in the book. It's in the process. And I think some of the things that you talk about, the quantitative hedge funds, I think is a tool that is building on the principles and frameworks that apply to every investor, in my experience.
Yeah. So as we maybe move towards a little bit of hedge fund talk, but part of what we at Carl talk about a lot is risk and reward, and how risk, the uber wealthy can pay more attention to risk sometimes than they even pay mind to the reward side. I read a little bit of your book, and it seems like you have some of those same perspectives. How do they attend to the risk side of their portfolio versus the reward?
Well, I think you're bang on. I think that in my experience, the wealthy are even more concerned about risk than the non-wealthy, and that simply the fact is that losing money at that point has a bigger impact than gaining an extra 1% or 2%. But to me, I think one of the key focus of the book is actually to explain the concepts, the foundational concepts like risk, return, in a way that I think the average person can use it, because that is a very misunderstood concept. And I'm sure you've seen this with your work with Carl. Risk is, in my experience, is unavoidable. You take risk by investing, you take risk by not investing. It's simply a question of trading off the risks that you can bear versus the risks that you can't bear. And I think your point about risk and return is, the way that I would describe it is that return is what allows you to accumulate the wealth beyond inflation, beyond taxes, and it's what allows you to bridge the gap between what you save and what you need, for example, in retirement. If it's enough to save, then nobody needs to worry. But we're investing because we need to have that money grow at some rate beyond inflation and beyond what we pay for taxes in order to have a large enough pool to be able to pay for the things that we want to pay in the future, whether it's retirement, whether it's your kid's education, et cetera. And I think that the one thing that I always try to emphasize to my clients and in the book is think of risk as the price you pay for return. And the key things to take away from that is too little risk and you don't get enough return. So think about putting money into a bank account or into a CD, a certificate of deposit. Sure, you're not taking a lot of risk, but you're also not making a lot of return. And the likelihood is that you're going to run out of money in 20 years from now because it's not growing fast enough. But on the flip side, if you take too much risk, you're putting into meme stocks. We've seen some of the things that have happened in the market over the last, few years, et cetera, and you may lose your capital. So risk adjusted return is the mantra or the holy grail that we're all striving for. What quantitative hedge funds like Carl or a well-diversified portfolio that I would have constructed for my wealthy clients or, that I would advise somebody in the book to do is a risk-adjusted portfolio, a risk-adjusted returns that is going to maximize the likelihood of you meeting your objectives, financial objectives, while taking the least amount of risk necessary. And least amount being something different than no risk.
Right. And least amount also potentially being, and this we only talk about slightly at Carl, or at least in the podcast episodes. There's emotional involvement, right, in risk. And I think you talk about this a little bit in the book, that each person really has to assess how much can you emotionally bear in risk, what makes it right for you. How do you find clients handle that?
Look, I think they handle it well when you can articulate it. And I think that, what I've seen is not enough of that happens in the industry. Fundamentally, what I've always told my clients is that it's a trade-off. Everything that you do. So you want to save for retirement, great. You want to, send your kids to an Ivy League school, great. You want to be able to, have 3 golf trips and 2 cruises every year, great. But, fundamentally, your resources may not allow you to do that. And what you have to think about is what trade-offs are you willing to make? And I think a job of a financial advisor is not to tell a client that this is the trade-off that you make, that your kid's education is more important than a golf vacation. I'm not going to tell anybody what their choices should be or their priorities should be. But I think it's important for them to learn that or know that they have to make those trade-offs. And I think there's not enough of that conversation occurring in the industry, where lots of people are told that, look, you can have your cake and eat it too. It will just grow, and somehow the magic of the market is going to allow you to do all of these things, et cetera. And then there's a rude awakening, 5, 10, 15 years down the road, et cetera, when the client realizes that, hey, they haven't had the money that, that the portfolio hasn't grown to what they were told to expect, when in reality, they should never have been told to expect that to begin with.
Right. So you actually talk a lot, well, at least in my reading of the book, what impacted me was that there's a lot of conversation about most financial advisors can't beat the market consistently. It's statistically, that's just the facts. Mm-hmm. So how do you see the financial advisor space, and what do you think it provides? If you're saying statistically you can't constantly beat the market.
Yeah, I think the point that I'm making about it not needing to beat the market is not saying that it's not important. And I use the example of Peter Lynch in the Fidelity Magellan case. So Peter Lynch averaged 29% a year return in the years that he was managing the fund, which is a phenomenal rate of return. But out of those 15 years that he was managing it, at least 2 of them, he was not beating the market. Does that make him a bad manager? No. The point is that we are creating expectations for financial advisors or the financial industry that we don't have in any other walk of life. We do not expect our dentist to be the best dentist that graduated out of their school. We don't ask our doctor, like how many patients have you killed in the last 5 years, et cetera. It's a macabre example. But the point I'm making is that the value of advice is in helping clients avoid the emotional traps and mistakes. So chasing out of greed, meme stocks are hot stocks because it's the flavor of the day. And, dumping out of fear a well-diversified, well-thought-out portfolio because the market suddenly is down at 10 or 15%. And that value of advice is far more important. And it's been proven by academic research, et cetera. It adds far more value to an investor's portfolio than trying to beat the market by 1% or 2% a year, et cetera. And I think the industry, I think a lot of financial advisors are doing themselves a disservice by trying to position that they can consistently beat the market. This is not to say that they can't. It's the idea that you can't consistently do it over 10, 15 years, and I don't know that should be the benchmark.
Right, exactly. So, we've talked about emotional investing or emotions involved in investing, and we've talked about risk and reward and how that plays into a portfolio. And we've just started a little bit on diversification. So bringing those 3 topics back around, what are your thoughts on then this new investment opportunity for any accredited investor in hedge funds, having their own fund of funds portfolio, as it were, on the Carl platform?
So I'll address that question in 2 ways. So the base in general terms, and then come on to the hedge fund platform. I think you nailed it on the head when you talk about diversification. So we talked about the objective of any portfolio to be to maximize your risk-adjusted returns while minimizing risks. And the way to do that is diversification. It's what your grandmother meant when she said, don't put all your eggs in one basket, right? So we don't hold just one stock. We don't hold just one bond. We hold a portfolio of each. But in this way, as you know, if you have a company, one company has a bad time, it doesn't drag down your entire portfolio. But what most people think of diversifying is by depth. So add more stocks, add more bonds, okay? Which I think in most cases or many cases makes sense. But in today's volatile and uncertain market, for instance, stocks and bonds are highly correlated. So we're seeing that the prices of stocks and bonds are going down together, which in normal times it doesn't occur. Okay, so this normal type of diversification isn't enough in volatile and uncertain markets. So you don't want to diversify just by depth. You want to diversify across by breadth and across asset classes. So you want investments that are less correlated to stocks and bonds. So this is where you want investments like hedge funds, like private equity, like alternative investments to round out your portfolio, because it's going to help deliver risk-adjusted returns that protect your portfolio in a volatile, uncertain market like we have right now. So that's the general point of what the role of hedge funds and alternative assets, why it's consistent with trying to build a better long-term risk-adjusted return portfolio. specifically talking about the Carl platform and hedge funds, et cetera, what it does is in my view, it democratizes hedge funds so that you don't have to be one of my former wealthy clients at one of the large institutions, et cetera, to have access to these suite of products that can help protect your portfolio in down markets. So I think Carl does a really good job of bringing high quality hedge funds, make it available and accessible to I'm going to use the term retail investors, but by that I mean people that don't have, you don't have to put $100,000 or $1 million into one strategy, which is in many cases, some of these hedge funds, that's the minimums that you need to kind of access. So the Carl platforms grants access to the retail investor to some really high quality hedge fund names. And makes it easy to do in today's world of digital onboarding and digital account management.
Yeah, thank you for that. Yeah, we would obviously agree. We think it's pretty easy to get on and significantly more accessible. I'll remind listeners that you can invest on the Carl platform with as little as 20,000, and you can diversify that into up to 5 funds. And we now have, I think, over 8 funds on the platform, so lots of opportunity. We do lean towards quantitative hedge funds, so they are, system and machine-based AI. Do you have any thoughts on the move towards quantitative investing or what's happening there?
Yeah, look, I think that the benefit of quantitative investing from the investment side is the mirror of what we talked about from the investor side. You avoid emotional investing, right? I mean, so what you get with the quantitative algorithms that in quantitative hedge funds, like the ones that Carl has on his platform, is you've got portfolio managers that have put in their thesis or their strategy, and they've quantified it and put it into an algorithm. So, they're not susceptible to emotions like greed or fear or like hanging on too long to a potential losing investment, because the algorithm is designed to kind of weed out all of those emotions that like falling in love with the particular investment, or hanging on and hope and a prayer that that the loser that you had in your portfolio is going to eventually kind of prove you right. So I think that there is a lot of value in it, and I think that it's data driven, and having a quantitative hedge fund strategies, I think, is again an alpha, potential source of alpha that I think that investors can access, and on a platform like Carl, access at far lower minimums, as you suggested, than they might be able to do elsewhere.
Great. Yeah, I hope we reach many investors, and we like that we offer the diversification that they haven't had before. It's what we do, and we take pride in it. I have to ask you while I have you. So, what are your thoughts? And I know we talked about alternative investments. We talked about private equity, and there's certainly real estate out there that has been, many invest in real estate as an alternative investment as well. Hedge funds just entering that space primarily through Carl as an opportunity. What do you think of the crypto space? What are your thoughts on that?
Well, I've written about it, and and I know that I may not, this may not resonate well with some of your listeners, but I'm not a particularly big fan of cryptocurrency, and for a variety of reasons. Number one, I think it's not a store of value per se, because at the end of the day, if you're having a cryptocurrency who's pegged to the US dollar, then it's not an alternative means of payment, right? I mean, it's still, ultimately you're converting it into dollars. If it's meant to be an easy, so it's not an investment. I don't necessarily think that your listeners think of the US dollar as an investment, or, pound sterling as an investment. It's a mechanism by which you hold US denominated stocks, US dollar denominated stocks, or pound sterling denominated. stocks. So there is no Bitcoin or Ethereum denominated assets that you can buy. You can't go on Amazon and buy your Prime Day purchases using your Bitcoin account or your Ethereum account. So and if you're looking for return, I would say cryptocurrencies, your source of return is speculation.
Right.
And again, by the way, you have to convert it. The only way you realize that return is if you sell it and get US dollars back in return, right? So I don't see it as an investment vehicle. I don't invest in cryptocurrencies myself. That's me personally. Do I believe that the underlying technology, like blockchain, has value and will take off eventually? Yes, I absolutely do. But the analogy that I would use is, and I was an investment banker in the dot-com boom, like the first Web 1.0 during the tech wreck. The internet was great, but the first set of companies that came out, like Pets.com or eToys, they were all great concepts, and they raised millions of dollars. And the idea was that, okay, we don't have bricks and mortar, but we can sell you toys online. Yeah, I mean, the concept was good, but what they realized, they all went bankrupt, as you know, and they went bankrupt because Toys R Us or PetSmart, had the logistics, had the buying power, had all of this. The only thing they didn't have was a website, which was the easiest thing to change.
Right.
So it didn't mean that the internet was a bad thing. So those early users of that technology, the first web companies, they all failed, but the technology improved and the internet is there. And now we use it for, companies like Amazon or others are using it and making money on it. So the underlying technology was sound. It was just the companies that were using that technology did not have a right business plan. So on the cryptocurrency, I would say I would liken blockchain to the internet, and the cryptocurrency firms to the equivalent of the first generation of internet companies, et cetera.
Yeah, I have to tell you, most folks who have worked in financial services for many years, they have the same. We tend to have the same position on crypto. It's just you're buying into speculation, and you have to accept that if that's what you're going to do.
And I think that's a great way of putting it, Jamie. Like if you accept it as speculation, and this comes back to risk-adjusted return, as we talked about, and diversification, et cetera. I'm not here to tell people don't invest in it. Just as you say, know what you're investing and why, and know what the risks that come with it and why. And if you're prepared to accept it, then you're prepared to accept it. But it's.
I think you said it right now. There's no real inherent value behind it. There's no company behind it. You have to know what you're investing in. At the same time, many hedge funds have added crypto into their portfolios. None that Carl has on our platform. We don't play in that space, but a very interesting space.
Yeah, look, I think you're always going to have people that pile onto the bandwagon, et cetera, because they also don't want. This is another way of managing risks, right? Like so the hedge funds are there are other firms that have invested in cryptocurrencies. Some of the large investment companies offer vehicles that invest in mainstream in financial firms that offer that. And I think there's a different question as to whether they believe in it or whether they say, you know what, there's enough of our clients that want it or believe in it. It doesn't really matter to us. Like you want to invest in X, Y, Z, we will, make it available for you to invest X, Y, and Z. We'll charge you a commission for the process. And,
exactly.
whether it goes up or goes down, that's on you, right? So
hopefully you know what you're investing in. Another question on the hedge funds, though. What do you think about, there is the idea that hedge funds had been exclusive to the uber wealthy and sophisticated investors, which I quote because exactly what that means. I find I have your perspective that just having more money doesn't necessarily make you sophisticated, but they have been for that group primarily because they're difficult to understand. you really have to be very involved in your investments to invest in hedge funds. And yet here we are, Carl's, we have the democratized platform for hedge funds. Um, uh, I mean, what do you think about, there is professional management of each fund, right? There is someone who has set a strategy. You have a professional manager there. What do you think about that with, I personally go on to Carl and make my own decisions about my investments. What do you think about that environment, and how will investors do?
Well, I think to your point about making it available to wealthier investors, traditionally hedge funds, it's a large part of that is for liquidity reasons as well, right? So like if you had a hedge fund, you were locked up, you have redemption, but it's quarterly or, or even longer. So, and part of the thinking is that wealthy investors can afford to have a portion of their money locked away for a period of time and not have access to it. And by the way, this is the same principle for private equity or any private alternatives, is that you get paid a little bit more as an investor for this illiquidity premium that you're giving. Like you're not, like if the market goes down by 20%, you're not, and you do that in real estate as well. Like the reason real estate is a good investment and people like it and you pay for it, although people don't, necessarily equate their thinking that way, is that real estate, you're locked in. Okay. You're not selling your real estate, and you're not watching it on a day-to-day basis. And if, tomorrow, if you want to sell your house or your apartment building or whatever, it's not going to sell tomorrow. It's going to take, whatever time it does. So you get a premium for that. And I think that was initially what the idea of limiting hedge funds to the larger investors was for, and the sophistication and knowing the risks and everything else. I think what Carl does, democratizing it, is okay. First of all, I think it gives access at lower price point. I think second of all, it's making that professional management and the explanation and the onboarding process and forms easier to access. The data is easier to access. And as well as there's the due diligence and review that Carl has done on bringing those names and managers on the platform. But I also think that the liquidity is and moving from fund to fund or having access to your money. I mean, it's better than what you would typically get at some of the larger hedge funds, and that you would have if you are a larger wealthy client, et cetera. So I think that's an element of the democratization process that I think that the Carl platform brings to the retail investor.
Yeah, great. Obviously, we would agree. I almost forgot about the liquidity piece. It's so common to me now. But yes, you can move money between the hedge funds on a monthly basis. So obviously not for a year or more. No lockup in that regard. So great speaking with you today, Sam. Love hearing a little bit about your book. You do have Making Your Money Work: The Secrets of Financial Health is out now. And we always ask, what is your last thoughts or perspective for our listeners?
Look, I would say I think hedge funds are a good part of anybody's portfolio that can afford it. I would say, like, building an investment portfolio is, I would say, it's like building a house. So you need to have the foundations, walls, doors, windows before you think about features like fireplaces or swimming pools. And I think good portfolio construction starts with a strong foundation of long-term stocks and bonds. And then you add important features like quantitative hedge funds through something like Carl, because then it protects your downside and gives you upside in a risk-adjusted manner in markets like we're facing today and probably for the next 5 to 10 years.
Great. Obviously, we agree. We think it's a great opportunity for more investors these days. Sam, thank you so much for joining us, investors or listeners. Thank you for joining as well. We will see you next time. Bye-bye now.
Thank you, Jamie.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.